Bank of America is now using Ripple technology and XRP. This headline has been spreading like wildfire across social media and crypto channels, and naturally, people jumped to one conclusion. If major banks are using this technology, it must be a massive investment opportunity. But here's the uncomfortable question nobody's asking. Does institutional adoption of blockchain technology mean you should buy the associated digital assets? The answer might surprise you, and it might save you from a very expensive mistake. Today, we're using the Bank of America and Ripple partnership as a case study, not to promote any investment, but to reveal a critical gap in how people understand institutional technology versus retail speculation. This isn't about whether blockchain is useful, it's about whether that usefulness translates into personal profit for individual investors. By the end of this video, you'll understand why banks can safely use these systems while individual investors often lose money doing the exact same thing. And before we dive in, if you're interested in financial literacy that cuts through the hype and focuses on real wealth-building strategies, hit that subscribe button. We're here to challenge assumptions, not sell you dreams. Let's get into it. First, let's get the facts straight about what Bank of America is actually doing. According to industry reports, Bank of America holds the highest number of blockchain patents among financial institutions globally. They're focusing on information security, payment technology, and cross-border transaction infrastructure. Their partnership with Ripple involves cross-border payment systems for institutional clients, using blockchain rails to reduce settlement times from days to seconds, participation in RippleNet's governance committee alongside other major banks, testing stablecoin integration for internal liquidity management. Notice what's not on that list. Speculating on price movements, trying to time markets, buying and holding digital assets hoping they'll moon. Bank of America isn't using this technology because they think the price will go up. They're using it because it solves specific operational problems, reduces transaction costs, speeds up settlement times, improves liquidity management, decreases counterparty risk. This is infrastructure investment, not speculation. And here's the key distinction most people miss. Banks benefit from the technology working, not from the asset price increasing. In fact, for many blockchain use cases, price stability is actually preferable to price appreciation. Volatility is a bug, not a feature, when you're trying to move hundreds of millions of dollars across borders. So here's where things get interesting, and where most people get it completely wrong. When you hear Bank of America is using XRP technology, your brain might translate that to, I should buy XRP. But let's break down what's actually happening on each side of this equation. What the bank is doing: integrating blockchain infrastructure into existing payment systems, running pilot programs with strict risk controls, hedging any exposure to digital asset volatility, operating within regulatory sandboxes, using the technology as one tool among many, never putting customer deposits at risk. What retail investors typically do: buying digital assets on exchanges, holding them hoping for price appreciation, exposing themselves to 24/7 market volatility, making emotional decisions based on social media hype, having zero institutional risk management, often using leverage or money they can't afford to lose. Do you see the problem? It's like watching a professional Formula One driver navigate a racetrack at 200 mph with a team of engineers, safety equipment, and years of training, then concluding, I should try that in my Honda Civic on the highway. The activity looks similar on the surface. The risk profile is completely different. Bank of America has legal teams ensuring regulatory compliance, risk management departments stress testing every scenario, hedging strategies to eliminate price exposure, governance structures with multiple layers of oversight. No emotional attachment to outcomes. The average person has a phone, an exchange account, hope, and usually a lot of fear and greed driving their decisions. This is not a level playing field. Section 4. How banks actually benefit. 2.5 minutes. Let's dig deeper into how institutional players actually profit from blockchain adoption, because it's crucial to understand this. Bank of America's involvement with Ripple isn't about buying low and selling high. It's about operational efficiency. Here's a simplified example of how cross-border payments traditionally work. Let's say Bank of America needs to send money from the US to Japan. The old system requires pre-funded accounts in Japanese yen, capital sitting idle, multiple correspondent banks taking cuts along the way, 3 to 5 business days for settlement, currency conversion fees at every step, reconciliation costs, and potential errors. Total cost could be 3 to 5% of the transaction value, plus the opportunity cost of locked-up capital. Now, with blockchain-based systems, near-instant settlement, seconds instead of days, reduced need for pre-funded accounts, fewer intermediaries, lower fees, better tracking and transparency. The bank saves money on every transaction. They free up capital. They reduce operational costs. Their profit comes from efficiency gains, not from the digital asset appreciating in value. In fact, many of these systems work better with stable prices. Imagine trying to send $1 million payment through a bridge asset that might fluctuate 10% during the transaction. That's a nightmare for treasury departments. This is why banks are increasingly interested in stablecoins and why Ripple is developing RLUSD, a dollar-pegged stablecoin. Stability matters more than speculation for institutional use cases. So when you hear banks are adopting blockchain, what they're really saying is, we found a more efficient backend system for moving money. That's great for them, but it doesn't mean the related digital assets are good investments for individuals. Section 5. The Trap. How Headlines Become Speculation Bait. 2.5 minutes. Now let's talk about how legitimate technology news gets weaponized into speculation fuel. Here's the pattern, and you've probably seen it 1,000 times. Step 1. Legitimate news breaks. Bank of America partners with Ripple for cross-border payments. Step 2. Crypto influencers reframe it. Breaking. Major bank confirms XRP adoption. Price explosion incoming. Step 3. Speculation explodes. Suddenly, everyone's talking about how this validates the investment thesis, how institutional money is coming, how we're still early. Step 4. Retail investors pile in. People who don't understand the technology or the actual business relationship start buying, afraid of missing out. Step 5. Reality doesn't match expectations. The bank continues using the technology for its intended boring purpose. The asset price does whatever markets do, which is often unrelated to actual utility. This pattern repeats constantly in the blockchain space. And here's what makes it so dangerous. The initial news is usually true. Bank of America really is working with Ripple. But the leap from working with to this is your ticket to wealth is where people get hurt. The narrative goes, if you understand this early, you can get rich. But understanding institutional blockchain adoption doesn't give you an edge in speculating on related assets. These are two completely different domains of knowledge. It's like understanding that electric vehicle technology is useful doesn't automatically mean you know which EV stocks will outperform, or when to buy them, or how much to allocate, or whether the current price already reflects all known information. The trap is thinking that awareness equals edge. Most people who follow crypto news are not less informed than the market. They're exactly as informed as everyone else reading the same headlines. There's no alpha in reading Twitter and Reddit. Let me spell out why institutions can safely use these technologies while individuals often lose money. Risk management. When Bank of America experiments with blockchain technology, they allocate a tiny fraction of their resources to pilot programs, have fallback systems if something goes wrong, hedge any market exposure, can absorb losses that would be catastrophic for individuals, make decisions based on 50-page risk assessment reports, not tweet threads. When an individual buys digital assets, they often put in more than they can afford to lose. Have no hedging strategy, make decisions based on social media sentiment, have no backup plan if things go south, lack the emotional discipline to stick to any strategy. Time horizon. Banks think in terms of 5 to 10-year infrastructure investments. Building systems that will process trillions of dollars. Regulatory positioning for the next decade. Individuals often think in terms of, when will this 10x? Should I sell now or hold? Checking prices multiple times per day. Reacting to every headline, incentive structure. A bank's success with blockchain is measured by cost reduction, transaction speed improvements, customer satisfaction, regulatory compliance, operational reliability. An individual's success in speculation is measured by price appreciation, timing entries and exits, outperforming other assets, not losing money. These are fundamentally different games. Information, asymmetry. Banks have direct relationships with technology providers, access to regulatory bodies, teams of analysts and legal experts, real-time data on actual usage and adoption. Individuals have public announcements, social media rumors, price charts, influencers with unknown incentives. This isn't a conspiracy, it's just reality. Institutions operate with resources and information that individuals simply don't have access to. So if speculating on blockchain assets based on bank adoption news isn't a viable wealth-building strategy, what is? Let's talk about real alternatives that have consistently created wealth over time. 1. Skill development and income growth. The most reliable return on investment is yourself. Learning high-income skills, building expertise in your field, and increasing your earning power gives you predictable returns. No market volatility, compounding benefits over decades, transferable value. Whether you're in tech, healthcare, skilled trades, business, or any field, investing time and money in becoming genuinely better at what you do has better risk-adjusted returns than speculation. 2. Building or buying productive assets. Real wealth comes from owning things that generate value, businesses that solve real problems and generate cash flow, real estate that provides housing while appreciating intellectual property that creates ongoing value, skills and relationships that compound over time. Notice the pattern? These assets produce value regardless of whether someone else wants to buy them from you at a higher price. 3. Systematic long-term investing. Boring beats exciting when it comes to building wealth. Diversified portfolios of productive companies, regular contributions regardless of market conditions, low-cost index funds, decades of compound growth. This isn't sexy. It won't make you rich overnight, but it's worked for millions of people over time. 4. Financial education. Understanding how money actually works. Tax efficiency, asset allocation, risk management, compound interest, behavioral finance. This knowledge protects you from expensive mistakes and helps you make better decisions over time. Here's the reality check. Most people who built lasting wealth did it through some combination of earning more, spending less than they earned, and investing the difference in productive assets over long periods. They didn't do it by catching the next big speculation based on institutional adoption headlines. The Bank of America and Ripple story is interesting from a technology perspective. It tells us that blockchain is maturing as a back-end infrastructure for financial systems. But it doesn't tell us that individuals should speculate on related assets. Instead of asking, should I buy this because banks are using it? Here are better questions. Does this asset solve a problem in my financial life? Does it help you save more effectively? Does it reduce your transaction costs significantly? Does it provide access to financial services you couldn't get otherwise? For most people in developed economies, the honest answer is no. Do I understand how I would profit from this? Is your thesis based on greater fool theory? Someone will pay more later? Or is there actual value generation you can articulate? Can you explain your exit strategy without using the words moon or Lambo? What's my opportunity cost? What else could you do with that money and time? What's the expected return of boring alternatives? How much of your focus and emotional energy will this consume? Am I confusing technology innovation with investment opportunity? The internet was revolutionary. That didn't mean every dot-com stock was a good investment. Most of them went to zero. The technology succeeded while investors lost money. Would I make this decision if nobody else knew about it? If you couldn't post about it? If you couldn't talk about it at parties? If there was no social validation, would you still do it? These questions cut through the hype and get to what actually matters for your financial well-being. Let me be crystal clear about what this video is and isn't. This is not an argument against blockchain technology, a claim that banks are wrong to adopt these systems, a statement that digital assets have no future investment advice of any kind. This is a warning against confusing institutional technology adoption with personal investment opportunity. A reality check on the difference between how banks use these systems and how individuals speculate on them. An invitation to think more carefully about where the hype ends and reality begins. The Bank of America and Ripple partnership is a data point about infrastructure evolution in banking. It's not a signal for retail speculation. Banks will continue adopting blockchain technology where it makes operational sense. That's good. It will make the financial system more efficient. It will reduce costs and increase speed for institutional transactions. But that doesn't translate into you should buy the associated assets and hope they appreciate. Those are two completely different activities with completely different risk profiles. Here's my challenge to you. The next time you see a headline about institutional adoption of any technology, pause. Ask yourself, how does the institution benefit? Is that benefit related to price appreciation? Do I have the same risk management capabilities they have? Am I confusing utility with investment opportunity? Real wealth is built through increasing your earning power, consistent saving, productive investment over long time horizons, continuous learning, avoiding expensive mistakes. It's not built through trying to front-run institutional adoption of back-end technology. If you found this perspective valuable, consider subscribing. This channel is about cutting through financial noise and focusing on strategies that actually work for real people building real wealth. No hype, no promises, no shortcuts, just honest analysis and practical wisdom. What do you think? Does institutional blockchain adoption mean individuals should speculate on related assets? Or are we confusing two completely different things? Drop your thoughts in the comments. Let's have a real conversation. And remember, just because something is technologically impressive doesn't make it a good investment for you. Thanks for watching. I'll see you in the next one.